I will profit volume chart with respect to multiple products. Earlier, we have already covered profit volume chart with respect to single products, and we'll be applying the additional assumptions where the production and sale will be assumed to be produced either in a constant mix or in order of the ranking, like the product with the highest CS ratio will be produced and sold first, and then the second one. So in order to discuss profit volume chart with respect to multiple products, I will be using one example from the technical article. We have two products, X and Y, each with a respective selling price of 50 and 60. Variable cost is also available. So contribution can be calculated as a result for each of the products. Budgeted sales, which is 20,000 and 10,000 respectively. So 2:1, you can say. Total contribution is also available. Total revenue is also available. Even the CS ratio is also available. So what you can see is that we can apply here two assumptions. If you remember, we discussed earlier in the calculation part that how we can apply these two assumptions. One of the assumptions was that the product will be produced and sold in order of the highest ranking CS ratio. This was one of the assumptions. And the other assumption was that the products will be sold in a constant mix. Okay, so if we have to follow the highest ranking CS ratio, as you can see that the CS ratio for product X is greater. So it means that product X will be produced first, and then we will go on and produce product Y. Okay, and if we have to sell in a constant mix, then we will be using weighted average CS ratio. Weighted average CS ratio is also available, as you can see here. Total contribution divided by total sales revenue gives us weighted average CS ratio. So first we will apply the assumption of highest ranking CS ratio on our profit volume chart, and then we will apply the assumption of constant mix. And then we will see how we can present this information. So let's have a quick look at what we will be doing here in our graph. So as we discussed earlier that on the graph, on one side, we will have sales. Let's say here we have the amount of sales revenue, and on one side, we will have profit and loss, right? So we also need to do some quick calculation to be able to determine how much will be our maximum loss if our production and sale is 0, and how will be our maximum amount of profitability if we achieve the budgeted sales revenue. So we will again go back to our scenario to have a quick look at what we have as a amount of sales revenue and the maximum amount of profitability that we can generate here. Because you cannot see the whole question, so one thing I will add here is that our fixed cost, the fixed cost of the company is 200,000. Okay, and as you can see that the total contribution we have is 550,000. So if I want to calculate the amount of profit, it will be the total contribution, which is 550,000 minus the fixed cost, that is 200,000. So we will have a net profit of 350,000. So when we go back to our profit volume chart, which we were discussing earlier, we have to keep the margins because our maximum sales is 1.6 million, including both the products, and our maximum loss is 200,000, and which is our fixed cost, and our maximum profit is 350,000. And we have to also keep this in mind that we will first be plotting our product X, which has the higher CS ratio. So product X has a revenue of 1 million, and that 1 million of the revenue will help us to generate a contribution of 400,000. If you remember, we earlier discussed that our fixed cost is 200,000. Okay, so if we will make a table to understand how much will be our cumulative profitability. So if our production and sale is 0, we will stand at a loss of 200,000, which is our fixed cost. Okay, and if we will first produce product X, which will generate a contribution of 400,000, which will allow us to recover our fixed cost and at the same time help us achieve a cumulative profit of 200,000. Okay, and then when we will add on our product Y, which will help us to generate total contribution of 150,000, which will take our cumulative amount of profitability from 200,000 to 350,000. This is our cumulative profit or loss. Okay, so when we will be presenting this on the profit volume chart, we will first of all start off with a loss of 200,000. Then we will present our product X with a cumulative profitability of 200,000, and then we will extend our graph by adding the sales revenue of product Y, which is 600,000. This revenue will help us to achieve a cumulative profitability of 350,000. So this is what we will be doing on our diagram. So let's go to our diagram now, where we will be presenting all this information. We have sales on this side as we discussed earlier. So let's say we have sales in terms of 100,000, 1.5 million. So sales we are going to express in terms of $1,000, and profit can also be expressed on this side in terms of $1,000, and loss can also be expressed on this side in $1,000. And also we can have here the amount of loss. As we know, it will extend up to 200,000, and the profit will extend up to 350,000. I'm talking about the cumulative profit or loss. Okay. Now, if we will sell, if our production and sale is zero, as we said, we will stand at a cumulative loss of 200,000. But then when we add our product X will generate a total sales revenue of 1 million. This revenue of 1 million, as we have used our table earlier, this revenue of 1 million will help us to achieve earn a total contribution of 400,000, which will take our cumulative loss from 200,000 to a profit of 200,000. So when I look at this diagram, the revenue of 1 million will help us to earn a total amount of profitability of 200,000. So we started from a loss of 200,000, and when we sold our product X, we ended up at a profitability of 200,000. So what I'm going to do is I'm going to connect these 2 points. Okay, so this is what we have, as this is going to represent our product. This is our product X. Okay, so this is the amount of profitability that we can generate with the help of one of our product, which is product X. Now we will add product Y. Product Y will generate a revenue of 600,000. So that will take our cumulative sales revenue approximately, I will say here, to 1.6 million. This 1.6 million will extend our profitability. This 600,000 additional revenue will add 150,000 to the amount of profitability. So already we have our profitability was 200,000. Now it will extend to 350,000. So let's say approximately it will take our profitability to 350,000. So when we will trace this on the other side, it turns out that the amount of revenue that we have generated around 1.6 million, it will help us to generate extend our profitability up to this point on the diagram. So now again, I will extend my diagram further from this point, which represents the cumulative profit with respect to product X, it will extend up to this point. Now, this second line which I have used is basically presenting our profitability generated with respect to product Y, which was a second ranked CS ratio. So this second ranked CS ratio has actually helped us to achieve a cumulative profitability of 350,000 based on the highest ranking CS ratio. Okay, so now we will discuss, we will add on to it that what if these products were produced and sold in a constant mix. If products are produced and sold in a constant mix, they will follow a linear pattern. Here what is happening, if you will see that this line product X having a highest CS ratio, if the other product also had the same CS ratio, it will extend in the similar direction, but that didn't happen because we were actually applying two different CS ratios. So this second half of the diagram you can see is bending slightly downwards. So when it is bending downward, it itself indicates that the CS ratio, which was going higher, now it has decreased, which reflects our falling CS ratio as well. Okay, so now moving on, we will also draw one line which will help us to present the fact that if both products were sold, produced and sold together in a constant mix. So what happens is that when products are produced and sold in a constant mix, in that case, what happens is that a linear line, as I said earlier, because average CS ratio is applied on both products, so a straight line, a linear pattern will be presented on the diagram, which will start from cumulative loss of 200,000 and it will end at a cumulative profit of, but in a linear pattern. Both are ending at the starting and ending is same, but the weighted average CS ratio, the constant mix, will follow a linear pattern, will not change its path because the average CS ratio will be same for both the products. So if I will then take another line to present this assumption of weighted average CS ratio, a constant mix, it will start and end at this point in a linear pattern. Okay, so what happens as a result of this, we are actually able to achieve the break-even point when we have the highest ranking CS ratio. We are able to achieve the sales revenue at, let's say, this amount of sales of 500,000. Lesser amount of revenue is allow us to recover our fixed cost and achieve the break-even point. Whereas when we sell the products in a constant mix, so we are able to achieve the break-even point at a higher amount of sales revenue. So it will take more amount of sales revenue. It will take more units. It will require more units to be sold to be able to achieve the break-even point. And practically, both these assumptions may not hold true. As I said earlier in the calculation as well, we may not be able to sell in the order of highest ranking CS ratio always, and we may not always be able to sell in a constant mix. So when we will discuss limitations of the CVP analysis, this is also one of the limitations, that the assumptions which we are using may actually not hold true. And if assumptions will not hold true, then it means the actual results could be different. So because we have already covered the calculation part, I would suggest you to apply the calculation part here as well on the available information. You can take the fixed cost, which I told you is 200,000, and you can take the weighted average CS ratio. You will be able to determine the break even in terms of sales revenue when products are produced and sold in a constant mix. Okay, and the same case you can apply if the products are produced and sold in order of the highest ranking CS ratio. So you will see that in highest ranking CS ratio, the break-even point will be lesser amount of sales revenue, and in case of the constant mix, it will take more amount of sales revenue to achieve the break-even point. So this is what we have for profit volume chart. After that, I will discuss with you contribution break-even chart and break-even chart. Both of these diagrams are going to be discussed in a similar way, for single product and multiple products, if we assume a constant mix, because then it will follow a linear pattern. Okay, so let's move on to the other two diagrams which we have.